Hello, this is Ed Butowski. I'm the host of Wealth Transparency. And today we have our two fantastic guests. We have Andrew Tang with Turner Financial Group and Michelle Connell with Portia Capital Management. And I want you to really take a hard look and listen to exactly what everyone has to say. Because what we try to do with Wealth Transparency is go behind the scenes of the headline stories and talk about what these little known storylines mean to you and your portfolio. And I want you to also reach out to either one of these people if you need any wealth advice. So, having said that, thank you very much. We took 2 weeks off. This has got to be about our 11th podcast. Please share this with your friends. This is content you can't get just anywhere. This is very, very unique information that you don't get on the mainstream broadcast networks. So, Andrew and Michelle, thanks for joining me today.
Thanks for
Thanks,
having me.
Ed.
So we hear the word recession a lot, and we hear it in the United States, but there's also global recessions, and these are when you see a slowdown in the world economy. And freight markets are quietly flashing the recession signals. Can you take us through a little bit of that, Michelle, and how that is happening and what that means for the world?
Well, if you have declining freight rates and loads, it means that manufacturers are shipping less. And if manufacturers are shipping less, there has to be a reason. And that means that they are selling less goods and there's less demand for their goods. And so that is the concern right now is the symptoms that we're seeing. Is it the fact that maybe there was too much capacity in terms of freight? And that's what I'm reading some places, that there was some excess capacity, but there is a higher amount of economists that are concerned about the fact that it could be signaling the fact that less demand means less sales, means you could have some sort of movement towards a recession, at least in the manufacturing side.
And Andrew, why do you think this is happening? Is this because of the war in the Middle East, or are there other macro factors at risk here?
Yeah, coming up, echoing what Michelle said, I think in this unique situation where we're in right now, it's more supply constraint and energy and resource constraint. And because of the geopolitics mess that we're in right now, we have countries that are not getting enough energy, they're not getting the raw materials, and therefore they can't really go on at full capacity. And so it is absolutely natural that you're going to see a slowdown in activities, but that doesn't mean that it's going to be a spot on demand decrease, because I have to mention to you that this ISM manufacturing PMI data just came in not too long ago, and it's reading 55.3. The street is looking for 53.8. And it's coming off of a low in February around 51 to 52. So basically, we bounced off the February low, and manufacturing activities in the US is actually improving 2 months in a row and is above 50, right? So you are getting a slowdown in freight movement. This is absolutely explainable. Is because the resources, the raw material, they're all being reduced right now because of the geopolitical risk, because the closure of the Straits of the Hormuz.
So, Michelle, from an investment standpoint, what does this impress upon you? What should people do as a result of this with their portfolios?
I think if you own a lot or a higher amount of industrials, especially if it's a heavier weighting than the S&P, and a lot of individuals and institutions did that towards the end of last year, the beginning of this, maybe you should lighten up a bit, because there could be some ramifications for the fact that shipping is slowing down and that manufacturing is maybe slowing a little bit. But as Andrew said, this might be a short-term, a blip in the road, or it may be signaling something that's to come. So it does bear warranting. So things like Deere and Caterpillar, et cetera, had been doing very well. Those stocks are cyclical, so they may, cycle through this.
I've always said that stocks are a great predictor of the future, and stocks move 6 to 9 months ahead of economic data. Right now, Starbulk, SBLK, and Global Shipping GSL, and then Zim, which is based out of Israel, are three of the global or marine transportation companies that I actually am looking at buying. I actually did buy some SBLK yesterday, and only because the dividends look so attractive. And I think that a lot of the bad news is already into these stocks. But Andrew, I want to talk about tariffs hitting smaller businesses
Mhm.
harder than large corporations. There's so much talk about tariffs for a while. Now that whole tariff discussion has kind of disappeared when the Supreme Court came down with their decision. What are your thoughts on the smaller businesses being hurt worse than larger corporations, which doesn't seem to make sense?
Well, to understand that in a way of why smaller companies hurt more with tariffs and economic changes is to understand the depth of their cash flow, right? The amount of war chest, how big is the war chest? So smaller companies are absolutely more prone to interest rate movements, cost of capital movement, and economic shifts. So what we just experienced with the geopolitics, stalemate that we have, you're getting a rise in prices because the shipments of goods and raw materials are not getting through. Energy costs are getting higher, and you don't have that capacity to reach into your balance sheet and say, okay, well, we can wait this out because we have this cash flow here, we have this assets there, and the investments here. No, a lot of small businesses, just like average American, they run month to month, paycheck to paycheck. So that is why small businesses are hurting more than larger corporations.
And these are all consumer product companies, not so much technology companies.
That's correct. Yeah. And technology companies will be a lot more sensitive to the borrowing costs and the cost of capital when you're at a smaller business. Yeah.
Okay, Michelle, let's switch over to credit card stress because credit card stress has, the usage and delinquencies have started rising quite a bit recently. And what kind of pressure does that put on interest rates?
Um, I don't know what kind of pressure it puts on interest rates, but it means that the people that need those credit cards are going to pay a higher amount of interest because they're typically the ones that are delinquent are those that are in lower income categories and don't have the ability to go out and get more credit. So those are the ones that are paying 23 to 26% interest on their credit cards. And that's you're seeing a lot of families with the fact that the average family is paying $400 $500 a month more in expenses because of more specifically their transportation costs and to some extent their food. So they're having, in order to meet their, the difference between what they're getting paid versus what they're spending on credit and it's costing them more.
Yeah, and they're just the people who spend on credit, and when they don't pay their bills, they then force it even worse for themselves.
Exactly. Unfortunately.
Would Visa and MasterCard be buys for you at this point?
Interesting. I was talking to a value portfolio manager that I know and I outsource to through separately managed accounts. And he owned Discovery for a long time, which was acquired by Capital One. And we're having this discussion, the fact that Capital One, I didn't know this, is now the world's largest credit card company in the world. And that's what they focus on are those individuals that need the credit and are going to pay whatever's necessary. So I think I'd look at those credit card companies that are going to benefit from this situation, maybe more so than an American Express is, the more affluent, who are using those cards for the points in the systems versus they aren't concerned about the rates. They're paying off their balances. So I'd be looking at the situations where they benefit from the higher interest rate and the consumer who desperately needs it.
So it's funny. I just got back from Italy, and every time I went to use my American Express card, they waved me off,
Yep.
saying that they don't want it because I guess American Express takes such a big percentage. Yeah.
Yep. Yeah, even now, if you go to restaurants, they charge you at least 3% for using a credit card, and they will always ask, hey, do you want to pay cash? And that's absolutely the case.
So, Andrew, in terms of the credit card pressure, where do you see the opportunity in the investment world?
Yeah, I see that, there are buying opportunities in the banks, but specifically, I have to say it's investment bank. It's not really retail bank or revolving around credit, unfortunately. I hate to steer this off topic. It's because we are going through an IPO bonanza. It is an investment banking festival for 2026. It's estimated that Goldman Sachs is going to make anywhere from 500 million, no, yeah, 500 billion to a
Right.
trillion dollars in fees, just for doing the SpaceX deal. So I probably shouldn't have said that because this is a
Yeah.
blockbuster topic here. But yes, there are opportunities in the banks, but I would prefer investment bank over regional banks or anything that has to do with credit cards.
Okay, and then all of this is somewhat kind of negative, but from a layoff standpoint, it's spreading beyond technology, transportation, warehousing, manufacturing, and retail supply chains. So we have higher interest rates, more delinquencies on credit cards, and more layoffs. Thus, going back to our very first subject, which was the world recession. Do you see the US and world economy starting to falter? And if so, what do you think that's going to do to interest rates? And are we going to get an interest rate cut? Michelle?
Well, Warsh gets sworn in tomorrow. I am glad that I am not him because he's got a very difficult job to do. I think it's going to be really hard for them to lower rates until things get so uncomfortable in terms of jobs that maybe they'll be able to lower rates. But at this point, I think rates are going to stay where they are. In other parts of the world, they're already starting to go up. I find it also interesting that when I was looking at small businesses regarding the previous topic that we were talking about, the research that I read through Claude, et cetera, was saying that small businesses are utilizing AI faster than a lot of large businesses because they operate on such thin margins that they're trying to catch up any way they can. So if they can use AI to replace human capital, they will. And that's concerning because we're seeing all these large businesses, right? All these announcements of layoffs, especially in the last few weeks with corporate earnings announcements. But to think that small businesses as well are doing that and actually ahead, that is concerning to me, is that if we continue to see more job losses and the higher cost of living, that may put us towards definitely something close to stagflation, hopefully not a recession.
You know, I'll tell you, I was talking to Andrew before we started this. I've started using Notebook LM, and I used to use Fiverr to create my whiteboard videos, and now
Mhm.
Notebook LM does an incredible job, and it cost me $20 a month, I think, to have a subscription to it. And Notebook LM is an AI uh, from Google. So
Okay.
I mean, it's just a little bit of a very small subsector of what we're talking about, but I definitely can see small businesses utilizing AI and therefore seeing these layoffs as well. Andrew, you have a final thought on that?
Yeah, absolutely. I think the layoffs that you are mentioning that's happening across transportation, warehousing, for example, and also manufacturing and then retail stores. These it's a summation of a couple of things, three things. One is that at the pandemic times, these companies they have overhired. Okay, at all levels, from large companies all the way down to small companies across all the sectors. And now they're just reversing these overcapacity. And then the second reason, it's really automation at different levels as well. So AI that falls into this category. And then the third reason will be the supply holdup that is causing the goods not being delivered, and therefore the manufacturing and business activities are slowing down. And so all these three reasons they contribute to the layoffs. But overall, I don't think that this is a dire situation. I think this is still somewhat a transitory situation that we're in right now. Now it really the whole world is looking at this Iran conflict with the Straits of Hormuz. How long is it going to take for it to open before the ports can flow freely, before trade can be free again? So I think, all this really hangs on how soon the strait can be reopened.
Okay, I want to throw in a final question. I didn't prepare either one of you for this,
Oh,
but
great.
getting asked about the best way to invest in public companies through for AI. And I'm tired of saying Nvidia and Microsoft and Meta. What are some of the smaller companies? Like I always say SoundHound and Big Bear. Are there any small AI companies that are traded publicly that you think have a huge future?
Yeah, I have a few. I can just blab it out if you want me to. Yeah.
Sure. Now,
Yeah, I mean, there's still a lot of cloud computing software related names that are just beaten up, but they're very much needed, in this AI race. Marvell is one of them. MPWR, it's another one, and then you have ARM. ARM is an architecture for chip making that is absolutely crucial. That you need that. Cerebus just came online with the IPO, CBRS. They are a specific AI chip manufacturing where it's an AI targeted wafer based chipset. So it's very, very different. The size of that chip is as big as this piece of paper. Okay. That's how big they are. And they are supposed to be more efficient than the current chips. And then there's a different layer of the component that goes into it. Obviously, your Western Digital, your Microns, Samsung, Hynix, and also SanDisk, all that they make memory. And you're going to have DRAM, you're going to have SRAM, and then you're going to have also the hard drive that goes with every piece of the hardware that you go. And then there is Supermicro that they make all these components that cools the computer. Those are the ones that I would revolve around. So it's not just the hyperscalers, but it's also a whole list of other companies that provide the components that makes the data center, for example.
okay, and Michelle, I know I threw this at you out of left field. Just want to see if you have anything off the top of your head.
A lot of the companies that Andrew mentioned, I would agree with. Also, it's important to keep in mind a lot of the big players have their own venture capital funds that invested in things like CoreWeave. I mean, NVIDIA was a huge investor and Google was in CoreWeave. And so if you're a small investor and you believe that the bigger names are very adept at using their cash flow, like some of the names that Andrew mentioned. I'll also say Broadcom. I love Broadcom because they're more involved in the intelligence side of the AI chips, and they have a fair amount in their venture capital side. That's versus NVIDIA, which is more the GPU at this point, also making a transition. But I still like NVIDIA because they announced yesterday that they're moving into robotics heavily, and they already have $9 billion in revenues from that. So they don't see just the data warehousing. I think they see that as their first entry into this space. And they're looking at a lot of different ways to participate in AI, including physical intelligence. So I think we need to look at the big picture and how it's developing. It's not just the data warehousing right now. I mean, this is going to be implemented broadly in many ways, for good or for bad, in
Yeah.
our society.
Yeah, I really appreciate both of your knowledge on all of these subjects. And for anyone watching this, please share this with your friends and reach out to Andrew Tang at Turner Financial Group and Michelle Connell at Portia Capital Management in Fort Worth. Thank you both for being here and look forward to talking to you next week.
Thanks for having me, Ed.
Sure.
Thank
Bye.
you, Ed.